Good morning. We are Group 3 and my name is Desna. Our topic is Financial Marketing and Capital Budgeting Analysis. The report will try to discuss the basic finance by the firstly introducing the definition of common stocks, bonds and preferred stocks. So at the very first point, there is common stock. Common stock is the residual ownership in the common divided amongst all large number of the individual investor. At the time of incorporation of a business, the character defines the different classes of stock. The owner of the common stock of a company are referred to as the common shareholders, which gives the right to attend general meeting held by the board and to vote on corporate matters. Second is bonds. When a company or government wishes to borrow money from the public on a long-term basis, it usually does by the issuing or selling debt securities called bonds and notes. The amount of the money which is usually borrowed and will be paid by at the end of the loan is the face value of the bond. Bonds are less risky. So the third point is the preferred stock. The preferred stock holders have no voice when it comes to the selection of board members or other key management professional. The preferred stakeholders receives a guarantee amount in dividends perpetually. As a result, they are higher in the chain when it comes to the claim the residual income, but the upward reward is limited, unlike the common stock, but the rewards are unlimited. Thank you. Now I would like to call my friend Robin. Thank you.
Thank you, my friends Sudeshna. Now I'm going to talk about the 5 basic principles of the finance. The first one is the cash flow is what matters. The cash flow determines the value of the business, as the cash flow are the different from the financial profit. For a business, it is possible to generate the profit. However, it is not necessarily that the cash flow always comes to be the positive for the business. While making the financial decision, a firm should always try to determine its incremental the cash flow. As for making any type of the investment, cash is an essential requirement. Now the second one is the money has a time value. The value of the money received today will be much more the value of the money received in the future. It is one of the core principles of the finance, as money can earn interest and the purchasing power of the money differ with the passage of the time. For any financing decision and for any investment decision, the idea of the time value of money is a critical analysis. Now the third one is the risk requires a reward. As truly it is said that if one takes more risk, the more return he will get. The business person also takes the risk to gain the additional returns. When the investor put their saving in the banks, they expect a return, and they expect to earn a higher rate of return on the stock relating to the saving account. Now I end up my speaking, and lastly I am Robin Yasin. Thank you very much.
Thank you, Robin. And the next one from the principle of financial business is market prices are generally right. It is seen that if a business decision is taken by analyzing the whole market condition, then it proves to be profitable for the organization. Actually, the value of the firm is determined by its stock price. Any change in price shows deviation in expected future cash flows. If the decision-making process is done by evaluating the market condition, then ultimately it will lead to increase in stock prices and also will be profitable for the firm. For determining the value of an asset, market price is used, because of which a reasonable and valid financial statement is prepared, which can be used by the stakeholders for taking the effective profitable decision for the firm. So the conclusion from this point is that before taking any decision, the market price need to be evaluated such that it can turn out to be profitable for the organization. The last one from the principle of finance is conflicts of interest cause agency problems. In a company or in a firm, there are conflicts between employee and employers. So agency theory mainly deals with problems arising between employer and employee. Separation of business from its owners leads to business entity concept. However, it also leads to agency problems. certain problems may arise when the manager's taken the decision. It is not necessary that when a manager takes a decision, it needs to be correct for the organization. So when the certain problem may arise when the manager take the decision which are not profitable for the organizations and also for the stakeholders of the firm. Mainly, this issue occurs when between stakeholders and business managers in a financial market. Whenever the management takes decisions which do not prove profitable for the stakeholders, agencies issue arises. It is the prime responsibility of the corporate managers to take the decision that will prove to be beneficial for both the company and also for the stakeholders. Now, this presentation will be continued by my friend Alicia. Thank you.
Thank you, Lakshmikant. Now I'm here going to describe about Australian bond market. Point number 1, bonds are generally low risk investment and considered to be very highly secure in nature. The secondary trading place for bonds after initial issue is the Australian Stock Exchange (ASX). Generally, bonds in the secondary market can only be bought through licensed broker like Cosmans. The two main types of the government bonds are also known as treasury bonds and the corporate bonds. Point number two, the bond ratings are assigned to the bonds based on the quality of the business, the risk of defaulting on the payment schedule. The three main rating agencies who assign the bond rating are Standard & Poor's, Moody's Investor Services, Fitch Rating Incorporation. Point number 3. The Australian government bonds are issued by the Treasury of the Australian government, whereas the corporate bonds are issued by the companies that are looking to raise the money to fund their business activities but don't want to issue more equity as it would dilute the ownership of the company. Point number 4. The market interest rate that equates a bond's present value of interest payment and principal repayment with its current price is known as the bond's yield to maturity. Point number 5. Interest rate risk is the risk that arises from fluctuation in interest rates. It depends on the duration of the bond remaining. The greater is the interest rate risk, the greater is the duration of the bond. Thank you. This is the end of my presentation. I like to call my friend Suchi for the further presentation.
So, thank you, Alicia. My name is Suchit Casey, and I'm going to discuss about the Australian share market. The Australian share market is the Australian Stock Exchange, or ASX as we know it. It is the 8th biggest market in the world. It comprises mainly of two industries or two markets, two categories, namely resources and industrials. The resources include the mining and energy companies, whereas the industrials include healthcare and technology. The market capitalization of the securities is the total value of its common stock multiplied by its current price. For example, if the Commonwealth Bank of Australia has 1.7 billion shares outstanding and its current price is $84, then 1.7 times 84 is the market capitalization value. Thanks for that. I'd like to call Regina for further presentation.
Thank you, Suchit. Firstly, I'm going to talk about the NBP analysis, and later I'm going to do the conclusion of our presentation. So the NBP, as per the initial assumption, was found out to be 64 million, which decreased significantly to 45.5 million if the price was reduced by 10%, and remained constant if the fixed price increased by 10%. The break-even quantity of sales if the price per unit decreased by 10% was found out to be approximately 1,42,681 through trial error method. So overall, we can see through our presentation, common stock carry out the most risks. They are the most rewarding investment, as well as whereas bonds and preferred stock are less risky, while lower return policy typically. All the market events could be analyzed with one or more of the 5 basic principles of finance. Also, Australian share market is one of the biggest in the world with the high quality of technology. Thank you.